In a wide-ranging interview with DBS CEO Tan Su Shan yesterday, I asked if the lender has plans to further purchase stock. The lender had declared a total dividend of 75 Singapore cents a share for Q1.
We announced a $3 billion share buyback a few months back, and we are still committed to fulfilling that. We can do that anytime in the next 2-3 years. We'll tend to do more when the stock price is lower, obviously. And we've done about 9-10% so far. So we're committed to that. We also announced a capital return program, and that was 15 cents per quarter. So that's about 60 cents a year. So the 15 cents per quarter capital return is 60 cents a year, and that's about 1.7 billion a year. So times 3 years, that's about 5.1 billion, and plus the 3 billion share buyback, that's about $8.1 billion. That's coming from our capital stock that we've accumulated over the last few years. So we've made the commitment, we'll stick to that. The rest of the dividends will come from our normal earnings, and at 60 cents a share, that's about 64% or so dividend payout ratio. That's quite manageable, and we should continue to do that.
I also want to talk about the return on equity. So this morning it was published, it came in at about 17.3%, which is down from the 19.4% when you compare it to a year ago. You previously quoted as having your eye on the ROE of 15 to 17%. How confident are you of hitting that target, given all the developments we're seeing in the macroeconomic environment?
So our aim is to still stay within our guidance of 15 to 17%, whether we're on the low or high side of the guidance will depend on where stock markets and wealth management fees go. It will depend on where the volumes of our deposits and assets are. And a lot of it will also depend on market volatility. Having said that, I'm quite comfortable we should, barring a black swan event or World War III, we should be within those guidance.